everyone, Bill Beimers here, and I'm joined by Chadirchi from Ausbil Investments. Thank you for joining and welcome, Hick.
Thanks, Bill. It's great to be with you as always.
And so, Hick, we stayed fairly close to you and other fund managers and economists during the quite scary time for many people last year. The correction and then the V-shaped recovery did eventuate, as many predicted and had hoped for as well. So now that this recovery has happened in the share markets around the world and in equities, looking at other asset classes such as bonds, fixed interest, cash, property, we're seeing a bit of a property bubble, or quite a major bubble in some parts of Australia. What are you guys looking at from a funds management perspective, and how are you thinking differently now than you were during the correction, and what should investors keep in mind?
Firstly, what we've seen over the last 12 months has been quite remarkable. Obviously, a very big sell-off this time last year. It was only the anniversary of the peak of the market last Saturday, the 20th of February, I remember it well, and the market fell, the Aussie market fell by almost 40% in the space of just over a month. Since then has rallied by over 50%. It's actually a little bit down today. So that's quite a V-shaped movement and recovery, and it's been replicated across many other asset classes as well. What's interesting is the global economic recovery hasn't been V-shaped, but we're starting to see real green shoots of recovery in across the developed world. Australia's not suffered as much as other economies, although it certainly has suffered. There's no doubt about that, and thankfully we've had lots of government support to get us through the lockdown-induced recession. Going forward, we're looking at a real return to growth in terms of economies. Well, how that plays out in markets is always a little different, because markets preempt. So we've seen that strong recovery in markets preempting an economic recovery. And what's quite interesting right now as I speak to you today is our market's down about 2%, which you could say is healthy profit taking after such a strong run. But it's also a reflection on the fact that there's equity markets and markets in general do look forward, and there's a little concern now that as economies around the world recover and all this stimulus is about, there may be inflation, which has caused the bond markets to sell off, and when bonds fall, bond yields go up. They're still really low by historical standards, but they have started to rise, and that means that some of the participants in the market are worried about rising bond yields, because generally rising bond yields can hamper economic growth. But because we're coming off such a low base, I don't think there's anything actually to worry about. What it actually reflects is that the increased inflation expectations are because the economies are starting to recover, and it's really just returning to a sort of more normalized level of expectation. So actually nothing to worry about, quite normal. We would say stick to fundamentals in terms of diversified portfolios across asset classes. What are we looking at now in a different way to what we were looking at 12 months ago? Well, certainly 12 months ago we were trying to protect capital in portfolios, being in defensive stocks. Then we moved to, when we saw all the stimulus coming from central banks, to going into sectors which would benefit from the support and the stimulus, and also might be COVID winners, where we know we've talked about this before, sectors which benefited from online, sectors which weren't affected by lockdowns. Then later in the year we started to rotate into stocks and sectors which had been hurt by COVID but would benefit in the recovery. Sure. And we've definitely progressively over the last 6 months been getting more exposure to certain stocks in those sectors. And I'll give you some examples of sectors. We like the banks right now, very economically sensitive banks. And if the economy is recovering, the banks should start to improve their growth. But more importantly, banks have had to set aside a lot of capital for the risk of bad debt and doubtful debts really increasing. And we think they've actually set aside more than they needed. So as that capital is taken back, it should be good for banks' profitability. So that's a real positive. Other sectors, of course, I've talked about it before, but travel, decimated by COVID. We should see an improvement there going forward. So we've had a position in Qantas for some time in travel, for example. But there's plenty of examples where we think you need to have some exposure to cyclical sectors right now as that recovery takes hold. And there's definitely been a rotation within market sectors in equities away from some of the COVID winners, especially in the last few weeks, towards some of those cyclical recovery stories. But we'll always have a balanced portfolio, Bill. So we're never going to hitch our portfolio to one particular sector or a number of sectors and ignore good quality companies in the sectors which may be a little bit out of favour, because good companies will always perform.
Certainly sounds like your search for opportunity is relentless. And it certainly has been a tricky one in the last 12 months. But your Ausbill's results have been very impressive. So we're very proud to be associated, and our clients especially, obviously. So what it sounds like to me is that within the funds management space that you're operating, it's very much about your own diversification, stock selection, sector analysis, and continued decision making there. But I suppose at a client level, it's more still about diversifying across the different sectors and the correct amounts of, as you say, bond yields. There was a sell-off which created bond yields to increase. Now, many people wouldn't understand what that means, but we know that bonds are a great shock absorber for portfolios, and in these times we've seen the benefits of that. So we'll certainly continue our client-focused strategy of diversification and into quality.
Oh, absolutely. You definitely have to have diversification in your portfolio, and times like February, March last year showed the value in that, because those defensive asset classes came to the fore, and they will do again. And so you definitely need diversification. And whilst we're predominantly equity investor at Ausbill, we do actually have some fixed income products as well. So yeah, we know the value of having diversification in a portfolio for sure. But even within our asset class, you certainly need diversification across various types of companies as well. So yeah, diversification is investment 101.
I had a client ask me a few days ago, Bill, where's Hick these days? People are really enjoying your updates and our chats. And I know we've been a bit quiet of late. We had Christmas, and when things are on the up and up, we tend to focus on other work. But we're at a critical point now. It almost feels like a T-junction where what's next. And it's good to hear your views on things, and that again, if you're getting the right advice, you're properly diversified, you're on the right track. So really appreciate your time, Mick.
Not at all, Bill. It's always a pleasure, and you're absolutely right. You know, it is a critical time, and we're laser-like focused on our investments. And you know, what I will say is, you know, there's definitely going to be bumps in the road going forward, but we are positive, and that's important. And that message needs to get out to your clients too. And I'm glad to help there, and I'm glad that they appreciate.
Certainly do, and we'll get that message out there. So thanks, Hick. Enjoy the weekend, and speak soon, no doubt.
You too, and you have a great weekend, and yeah, we'll definitely speak soon.
Cheers. Thank you.